There's been a lot of volatility in the bond market and equities market with higher than expected consumer price index report that just came out last week. Mortgage rates leaped from about 5.5 last week, and on Monday they were 6.13 just yesterday. And the Feds are currently meeting today and tomorrow, and we're expecting a 75 basis point jump in rates. And I'd like to introduce Anouheh from Movement Mortgage. Where are mortgage rates headed, and how long before we get inflation under control, Anouheh?
Well, that is the big question, and you're absolutely right. All eyes are on the Feds right now. And in anticipation of what the Feds are going to do, and with their results tomorrow, it's supposed to come out at 2 p.m. The market has taken a dive. Interest rates have peaked. The 10-year Treasury, guys, Friday, the 10-year Treasury was at 2.9. By Monday, it was at 3.6. The 10-year Treasury does not move that much. Wow. So on Friday, we saw a midday rate increase. On Monday, we saw 2 midday rate increases. Now, this all seems like doom and gloom, but I don't want you guys to look at it that way. The big keyword here is recession, right? What is the definition of recession? 2 quarters of GDP negative growth, right? So Q1 of 2022, we had negative growth. Q2, obviously, we're going to have negative growth. The GDP report won't come out until mid-July. The average number of months of recession that the US has experienced since World War II, you can Google this, is about 10 months. So the good news is by mid-July, we're already 6.5 months in, guys. that means if we go by the average, we should be out of this by like October, November. Now, could it go longer? Absolutely. But we gotta look at it as what the reality is that we're facing. So homes are staying on the, go ahead.
Inflation's kind of out of control. I think everything is so expensive. We need to get inflation under control, don't we?
Yes. So a couple months ago, we had this discussion. Inflation was over 8%, the highest it's been in 41 years. Well, the inflation report just came out. It's at 8.6%. I mean, this is what's really making the Feds scramble. They weren't supposed to raise the Fed rate more than 50 basis points. Now we're hearing whispers of 75 basis points. I want to get back to homes not selling. It's not that homes aren't selling. We're coming off of 2 years where you really had to be like right at the door of the house when the house went on the market, or your buyers weren't going to get their offers accepted, right?
That's right.
And so now, if a listing agent has to list the house for over 3 weeks or 4 weeks, they're feeling like it's a huge failure, but that's not the case. In the grand scheme of things, a month or 2 on the market is not terrible. Just like a 6% interest rate is not terrible. Now, let me tell you what is causing all this doom and gloom in the consumer's eyes. Rates typically don't go up this fast. Rates are moving at an accelerated pace. It takes consumers a while to digest that, oh, my rate doesn't have a 3 in front of it anymore. Wait. Now it's a 4. Whoa, 5. Now I'm at a 6. So the reason you're seeing a little hesitation, it's not that buyers don't want to buy homes. It's that they're trying to wrap their brains around this rate. And really, the discussion shouldn't be around the rate, right? The discussion shouldn't be about timing the market. Yep. It's the time in the market. Buy the house, sit on it, it'll appreciate. If you're trying to flip, if you're investing, different story. But don't get discouraged. Don't allow your sellers to get discouraged, and help your buyers understand what's going on in this market so they aren't freaking out, because it's not a freak out. There's no freak out needed.
I appreciate it, Anouheh, and you're just right. We're still selling. Last year, we did 1.5 year to date. Last year, we did 1.577 billion. This year to date, we're at 1.506 billion. We're only down about 4% in volume year over year. Our transactions are another story. Last year we were about 1,250 transactions. This year we're just over 1,000, and we're down about 19% in transactions. We're only down 4.6 in volume. So let's look at some data. If we go to our first slide, we have rising inventory. The active inventory of active listings increased to its highest level since August of last year. That's an 8% increase year over year. However, we are still experiencing low inventory. The 3-year average prior to COVID was 47% more homes on the market than there is today. If we go to the next slide, demand is the number of pending sales over the prior month. It decreased by 305 pending sales, or it's down 6%. People are still buying. We're still hearing things of multiple offers, and I think the good properties are selling quickly. Last year, there was 36 more pending sales than there is today. The 3-year average prior to COVID was 22% more. If we go to slide 3, expected market time is increasing. We're now just under 60 days on market for all of LA County. We are in a transitioning from a hot seller's market to a slight seller's market. And the last slide here, to put it another way, we're still seeing more inventory in the lower end and longer market time in the high end. Pay attention to the data. Use these. These will be posted on the hub and the portal after the meeting. Excuse me. Educate your buyers, especially your sellers. Moving forward, we're going to see more of a price-sensitive market. Be careful not to overprice those new listings. Get out there and focus on your clients.